Option trading is a financial derivative strategy that involves the buying and selling of options contracts, which give the holder the right, but not the obligation, to buy or sell an underlying asset at a specified price, known as the strike price, on or before a predetermined expiration date. Options are commonly used to hedge against price fluctuations, generate income, or speculate on future price movements. There are two main types of options: call options and put options. A call option gives the holder the right to buy the underlying asset at the strike price on or before the expiration date. Call options are typically used when an investor expects the price of the underlying asset to rise. If the price goes up, the call option can be exercised to buy the asset at a lower predetermined price. The buyer of a call option pays a premium to the seller, writer of the option. A put option gives the holder the right to sell the underlying asset at the strike price on or before the expiration date. Put options are generally used when an investor expects the price of the underlying asset to fall. If the price goes down, the put option can be exercised to sell the asset at a higher predetermined price. The buyer of a put option also pays a premium to the seller, writer of the option. Here are some basic terms and concepts related to option trading. Strike price, the price at which the underlying asset can be bought for call options or sold for put options when the option is exercised. Expiration date, the date when the option contract expires. After this date, the option is no longer valid. Premium, the price paid for the option contract. It's the cost of acquiring the right to buy for call options or sell for put options the underlying asset. In the money, ITM, an option that has intrinsic value. For call options, it means the underlying asset's price is higher than the strike price. For put options, it means the underlying asset's price is lower than the strike price. Out of the money, OTM, an option with no intrinsic value. For call options, it means the underlying asset's price is lower than the strike price. For put options, it means the underlying asset's price is higher than the strike price. At the money, ATM, an option with a strike price equal to the current market price of the underlying asset. Option writer, the individual or entity who sells the option and receives the premium. They have the obligation to buy or sell the underlying asset if the option is exercised by the holder. Option holder, buyer, the individual who purchases the option and holds the right to exercise it but is not obligated to do so. Option trading strategies can vary in complexity and risk, including simple strategies like buying calls or puts, to more complex strategies like spreads and straddles. It's important to thoroughly understand the risks and potential rewards associated with options trading.